When talking about the pre-crisis economic situation in Iceland, on late 1943, Denmark and Iceland had an active union for the past 25 years, but Icelanders were not content with the union anymore and wanted to be an independent republic, which in the early 1944 they established, having Svein Björnsson as the first elected president. After World War II, and with the help of the Marshall Plan program, they started to develop the fishing industry that was the main economic sector for several decades, and in 1994 joined the European Economic Area, which led to the constant growth of Icelandic economy. When talking about the causes of crisis in Iceland, in 2001 all of the banks were deregulated, so the debts with foreign companies were accumulated and banks became unable to refinance their debts. The three major banks, which started with exponential growth as in 10 times the size of their economy, were holding a foreign excess debt of over 50 billion euros, which found increasingly difficult or almost impossible to roll over the loans in the interbank market, and instead to ask from the loan to a central bank, which most of us would do, that certainly couldn't afford it. Banks were declared bankrupt and collapsed, letting foreign investors such as Britain and the Netherlands to lose their money, but managed to guarantee its national deposits by proclaiming them priority claims. Talking about the history of Iceland, with all the transaction and crisis the banks faced, the currency declined in a direct way as well, so the government had to take measures to stabilize it by setting up a temporary system of currency auctions held by the central bank, which is a system where the krona, Icelandic currency, is determined by the supply and demand of these auctions. These actions happened between October 2008 and January 2009. The 28th of October of 2009, the International Monetary Fund, or IMF, approved the Icelandic Economic Recovery Program, which consists on bailing out the government after the krona crashed even more. In sum, the government received $4.6 billion, 2.1 from the IMF and 2.5 from Scandinavian neighbors. In 2011, the recovery program ended with a completion of its three key objectives, which is maintain public finances on sustainable path, stabilize the exchange rate, and finally the reconstruction of financial sector. From 2010 to 2012, the exchange rate strengthened by 11% and inflation kept rising 2.5% on yearly basis, getting to 6.5% on the first months of 2012. For the fact that inflation was increasing, the central bank kept from increasing the policy rate. The advantages after the crisis are that Iceland was able to repay its loans received from the Nordic countries and the International Monetary Fund, which positioned it on the top of economic performance in Europe. The second one is that it has to maintain low inflation, stabilize exchange and market access, and finally is that it's making good use of natural resources such as fishing industry and clean geothermal energy, which has been very attractive for foreign industries. Some of the disadvantages after the crisis are that doing business with foreign partners has very low demand because countries still don't feel very comfortable to do business with. The second one is that the banking sector is under the influence of the government and not personal ownership. Third one is that they need a new financial housing program. And finally, they need to stabilize the financial supervisory authority with a plan for bank supervision that focuses on the deposit insurance system, the emergency liquidity assistance, and finally the bank resolution process.
Greece was the only country in the Balkan Peninsula not touched by the communism. Although the country is located on the peripheries of the European economy, it noted the percentage GDP growth comparable to Japan after Second World War. It lasted until 80s when the leftist government started to raise government spending significantly, causing high inflation rates, high fiscal and high deficits, trade deficit, low growth rates and several exchange rate crises and a debt to GDP ratio of more than 100%. Given these conditions, Greece was not definitely ready to sign the Maastricht Treaty. Greece's main industries are tourism, shipping, industrial products, food, tobacco processing, textiles, chemicals, metal products, mining and petroleum. The biggest problems with which it had struggled and continue to do so now are inefficient public sector bureaucracy, tax evasion, corruption and low global competitiveness. To illustrate the scale of the problem, Greece is ranked 58th in the world Corruption Perception Index. Moreover, Greece also has the EU lowest index of economic freedom and global competitiveness, ranking the country on the 130th and 81st place in the world respectively. There are several causes of the Greece crisis. First of all is the adoption of euro as a currency. The Greek government was determined to join a single currency area because of the conviction that the monetary union backed by the European Central Bank would help fight inflation, lowering nominal interest rate, thereby encouraging private investment. In 2004, the Greek government admitted that it falsified its financial data in order to enter the Eurozone. Interestingly, the EU did nothing to impose sanctions. First of all, France and Greece spend above their limit, so it would be hypocritical to sanction Greece until they impose their own authorities measure first. Uncertainty on what sanctions to apply, and the EU had the purpose to strengthen, not to weaken, the power of the euro international currency market. A lower interest rate that allowed Greece to borrow at much cheaper rate during the times of drachma. The lack of revenue phenomenon delivered by the tax evasion, primarily coming from the high-class society, bankers, lawyers and professional workers. Greece couldn't keep up with the productivity of Germany and other countries of European Union by adopting the euro. By giving up the independent monetary policy, Greece lost the ability to evaluate its currency, and consequently Greece decreases its trade balance, increasing its current account deficit. In case of positive things, Greece's 4 banks are in the best shape in years. In November 2015, they received their bailouts as in many years. The extra 14.4 billion euro raised their capital ratios to 18%. The Bank of Greece has quite a positive view of their future, as it predicts that growth could return as early as this summer after 8 years of crisis and recession. However, on the negative side, beneath the cushion of fresh capital, the crack is still massive. Greek banks are still losing a lot of money. The Piraeus Bank, the second largest lender in Greece, has reported a loss of nearly 2 billion euros in 2015. Deposits barely began to grow again after last year. Where 40% of loans and 55% of mortgages have not been paid, compared to the European average of 5%. All these big losses on non-performing loans and the debt securities could take the bank's capital once again.